Welcome to The Explainer. Today, we're diving into the curious case of a penny stock that just did something, well, something pretty wild. We're going to play detective, follow the clues, and figure out what's really going on here.
So here's the number that got everyone talking. The stock, PAVS, jumped over 16% in a single day. I mean, on the surface, that sounds fantastic, right? Time to pop the champagne.
But, especially with penny stocks, that headline number is almost never the whole story. So the real question is, what is this surge all about? Is this some kind of incredible comeback story, or is it a trap just waiting for unsuspecting investors?
Okay, to really start our investigation, we've got to rewind the tape a bit. To understand what this 16% jump means today, we first have to look at the absolute wreckage of the past year. And just a heads up, it is not a pretty picture.
Just look at this. It's an absolute free fall. A year ago, this stock was trading at $1.50. Today, it is barely hanging on at just over 3 cents. You guys, this is not just a dip. This is a total wipeout.
And to really put a fine point on it, the stock is currently trading at less than 1% of its 52-week high. All of a sudden, that 16% gain feels a lot less like a recovery and more like, a muscle twitch, doesn't it?
And if we check the vital signs, things look pretty grim. It's in what's called a severe bear market, way below its long-term average. And check out that ATR, the average true range. That's a measure of volatility. And here, it's so high that the stock could literally double or get cut in half on any given day. It's like riding a roller coaster with no seatbelt.
All right, so that brings us to our first major clue in this investigation. Is any actual money flowing into this stock? Is this price jump being fueled by real investment, or is it just some kind of ghost in the machine? Let's follow the money.
And this is really the core of it, isn't it? A price jump without a lot of people buying is kind of like a car that looks great but has an empty gas tank. It might look like it's going somewhere, but it's not. So, what are the volume indicators telling us?
This leads us right to a classic, if kind of grim, trading term, the dead cat bounce. It's a dark name for a really simple idea. It's a temporary price spike in a stock that's otherwise in a long-term freefall. It's a classic trap, and a lot of investors have fallen for it.
And here we go. This is our smoking gun. This number is the on-balance volume, or OBV. Think of it as a running total of buying versus selling. And as you can plainly see, it is deep in the red. This tells us that for a long time, way more people have been running for the exits than coming in the front door.
Oh, but it gets worse. This number here is the ADOSC, or the Chaikin AD oscillator. It's basically a lie detector for money flow. And it's screaming at us that even on a day when the stock price went up, money was still actively pouring out of the stock. That, my friends, is a 5-alarm fire.
So the verdict on our first clue's in, and it is crystal clear. The money flow shows this is distribution, not accumulation. In other words, the big players are selling, they're not buying. That 16% jump, it was nothing more than a mirage, probably created by some short-term speculators, not long-term believers.
Okay, let's move on to clue number 2, checking the engine's power. I mean, if money isn't fueling this thing, maybe the stock has some kind of internal momentum, right? So let's pop the hood, let's check the gauges, and see if there's any real horsepower under there.
And nope. The engine is completely sputtering. The RSI, which measures momentum, is barely even moving. The MACD and TRIX, which are kinda like long-term health monitors for the trend, are both flashing bright red. The momentum is down, and it looks like it's staying that way.
But even in the biggest storm, sometimes you can find one little glimmer of light. And believe it or not, buried in all this negative data, we did find one tiny little contrary signal.
It's something called the Stoke RSI. It's a super short-term indicator that was hinting at tiny bounce was possible. But let's be really clear about this. This isn't a lighthouse showing us the way to a safe harbor. This is like lighting a single match in the middle of a hurricane. It's not going to change the direction of the storm.
All right, so it's time for the final verdict. We've looked at the scene of the crime, we've followed the money, we've checked for a pulse. After all of that, what's the bottom line on this 16% jump?
Well, the evidence is pretty overwhelming. The long-term trend is absolutely broken. The bounce we saw was purely technical, a blip, and the big money is still running for the hills. As far as this investigation goes, case closed.
So what happens now? Well, there are really only 2 paths from here. The bullish, optimistic scenario? Maybe some more speculation pushes it up to test around 4.7 cents. The bearish, and frankly more likely scenario, it breaks below its support level at 2.5 cents, and that's like falling off a cliff where there's no bottom in sight.
So, for the very next trading day, what should you watch for? Well, the technicals are pointing to a weak or flat open. The real test, the main event, will be if the stock can hold that critical 3-cent level. If it can't, things could get very ugly very fast.
So I guess it all leaves us with this final question. When a stock's fundamental story is this broken, what does a big one-day jump of 16% really mean? The big takeaway from this whole investigation is that a big green number can grab your attention, but it's rarely the full story. If you don't dig deeper, if you don't look at all the clues, you just might mistake a dying gasp for a sign of life. And in the wild world of penny stocks, that's a mistake you just can't afford to make.